Good morning, everybody. Welcome to today's live event. We're going to be looking at the Producer Price Index report that comes out in about 12 minutes from now. I'm joined by Jose Torres, our Senior Economist. I'm Andrew Wilkinson, Director of Trading Education here at Interactive Brokers. Morning, Jose. How are you doing?
Good morning, Andrew. Doing well. This PPI report is expected to come in at 4.6%. Let's see how the market handles it. Let's see how yields manage it. And let's see if the stock market momentum can endure this elevated wholesale inflation print. Tech stocks here, Andrew, looking for their 10th consecutive day of gains. So pretty impressive run off of the lows on March 30th.
Yeah, we seem to have, or investors seem to have left behind. They've kind of done what Artemis did a few days ago, and they've really kind of taken off from the launch pad and not looked back, really. It's been quite an impressive rally, and still, you know, there's this situation in Iran where US, Iran, Israel, they're all at a logjam, and it's keeping the price of crude oil above $100. That's a significant inflationary concern going forward. And correct me if I'm wrong, Jose, but I think President Trump the other day said that, yeah, this isn't going to resolve itself quickly, and you might need to get used to high gasoline prices at the pump right through the midterms. That's 6-7 months from now.
Well, Andrew, you know, the president has really been all over the place with his statements. So, you know, let's start off with that. As far as the inflationary risk, you are 100% correct. I think the market is essentially pricing in a Fed that's not going to restrain these elevated price pressures. Let's see how the Fed meeting goes. We got a Fed meeting this month. But it'll be interesting to see what the 10-year does. The 10-year here is at 4.30. And today's PPI is expected to come in at 4.6% year over year, alongside a month over month of 1.1%. Now, folks, 10 minutes until the report comes out. I think we're going to get a hotter number.
Okay, before we come to the guts of the number, tell us what producer prices measured compared to the consumer price index that we reported on last week, and why it's important.
Yeah, so the producer price index, as the name implies, it's more about producer to producer. So it reflects more the input costs as goods and services pass through the supply chain before it gets to the end user, where that would be the consumer price index. So there's a few, products change hands, services change hands a few times. There's inputs from many different establishments, and the costs that go on at the producer level tend to provide a preview to what's going to happen with the CPI. Yes, it's a lead. And while we discuss this a little further, I'm actually going to show a chart of the CPI overlaid with the PPI so that the audience can understand why a 4.6% expected PPI could be a source of concern.
And my recollection, Jose, as you're pulling that chart up, is that it's very, very difficult to get away from crude oil prices when it comes to any sort of any flavor of manufacturing, right? So what happens in the producer price land is often a function of the price of oil and energy, is it not?
Yes, absolutely. And it's much more physical product oriented, much more energy sensitive, which is part of the reason why I think that 1.1% month over month is too low of an estimate. The CPI was 0.9. And the CPI served to downplay the pressure of those gasoline prices. I think the PPI is going to come in maybe 1.3, 1.4, and the annualized figure is actually going to come in instead of 4.6, 4.7 or 4.8. What does that mean for the CPI going forward? I've been telling you folks, ladies and gentlemen, throughout the most recent live streams, that there's a real risk of the CPI heading to a 4 handle this summer. And this PPI heading into the high fours today expected, or more, higher. Of course, potentially less, but still expected 4.6. That is emblematic of the risk to consumer price pressures going forward, because it takes a while for those higher input costs to work their way through the supply chain and then make it to the end user.
Yeah, there's a lot of compression, and people or manufacturers and suppliers kind of crunching on those margins so that it doesn't end up on the consumer's plate, because it's not very palatable. So is that perhaps one reason, Jose, why the Fed might be looking through these numbers?
Yeah, I think so. I think the Fed is essentially trying to stay where it's at in terms of rates right now, and then hopefully when the oil shock subsides, then inflation can get back to low twos, and then the central bank can remain on a steady path. But of course, if inflation starts to move higher and we start in the CPIs in the mid threes to the high fours, then of course you start considering hikes, at least as a marketplace. Of course, we have new Fed chair coming up soon, chosen by the president. So we'll see, if there's any lean to the dovish side. So far, the markets think that, because you had the 2-year yield go above 4% a few weeks ago, and the marketplace started pricing in a hike, but then that quickly just dissolved itself, and we stopped talking about a potential Federal Reserve increase. So the proper policy here, I think, in the next month or two, if we keep getting these inflation reads in the threes and the fours, would be to increase interest rates.
So let's have a look at the chart, Jose. Have you found it yet? And in the meantime,
yes, I am. Give me a 30 seconds. Let's go to Steve Sosnick real quick. What do you think?
Okay, let's go.
Hi, I'm Steve Sosnick, Chief Strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy yes or no contract on ForecastTrader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose Interactive Brokers.
All right, we're back.
All right, and the chart is ready. So let me pull this up, folks. So here we have the PPI on the green dotted line, and the blue line is the CPI. And if we go back to January of 2021, we see that the PPI started rising faster than the CPI, got up to 11% or so, and really led the increase for the CPI, and then began to decline faster than the CPI. So essentially, it's when a PPI ascends, generally speaking, it's telling you that an acceleration in the CPI is on its way, and that's what we saw back in 2021 when the PPI, when it got to 11.59% here in the month of March, and the CPI got to 9.1% in June 2022. And then PPI started decelerating, and then the CPI followed. And that's why it's, they're called cousins by the marketplace. They essentially work together. But the reason I think that this report could be hotter than expected is because it's more energy focused, it's more tariff influenced. So a lot of those price pressures could make their way in the PPI for March, much more than the CPI reflected. Also, there were some quirks with the CPI report. Used car prices went down, where the Manheim used car index actually reflected an increase. Also, gasoline prices, what we saw from the Department of Energy report wasn't consistent with the CPI. So the CPI downplayed that gasoline increase that we saw in March, potentially pointing to more of an impact in April. So we'll see how the PPI considers all those points 3 minutes into the report. And the market is doing very well against this backdrop. You replace the screen here.
That's the S&P 500 or the E-mini S&P 500.
Yes, this is the S&P 500, the implied open, 6905. Folks, as you can see, this has been really a tremendous rally here from the lows on March 30th, around 63.17. Now we're set to open above 6,900, and 7,000 is really not far away at this point, which would, mark close to an all-time high. This is a year-to-date chart on the S&P. The 7,000 level has been particularly a source of resistance for the market, big round number. The market here is above its 50-day, 100-day, and 200-day moving averages after being below all three of them throughout this period. You could argue that this is a point of resistance here if you draw a downward trending line pointing to some lower highs, and maybe the bears could catch a break here if the PPI comes in hotter than expected, or you can continue to have optimism about an Iran-US deal. Something Chief Strategist Sosnick spoke about, we're 45 seconds away from the report, is that you had a lot of enthusiasm on this dip buying spree because last year during the Liberation Day sell-off, folks felt like they missed out, like they sold and they felt so bad for selling because the president was going to turn it around. So this time around, people weren't as fast to sell. People wanted to stay in the market. People wanted to buy the dip because they essentially expected the Trump put to kick in. Also from a seasonal perspective, Liberation Day tariffs, that was last April. We're in April. So, maybe this is, these are the times where you get deep volatility to buy under the Trump administration.
Jose, remind us, PPI month on month is expected to be what? Up?
Expected 1.1%, and the number should be out now.
So we're going into the release now. We'll see a market response probably. Although, as Jose just pointed out, the E-mini futures are up about 16 handles, with the 10-year at around 4.3. So looking for reactions in both of those, depending on those numbers.
Yeah, so much cooler than expected. In at 0.5% month over month and 4.4% year over year, much cooler than expected. The S&P holding its gains up around 30 basis points. Yields, that line, 10 years at 4.28, 2 years at 3.77. 0.5% month over month is actually the same increase as we saw in February. The year over year did accelerate from 3.4% and by a lot on the year over year from 4.6%. So much milder than expected. We looked at what drove the increase. We saw a decline in food. Sorry to interrupt, Andrew. We saw a decline in food, 0.3% month over month. Energy only up 8.5% month over month. This is very strange, folks, because if we look at gasoline and crude oil costs in March, it's much higher than 8.5. So the PPI essentially downplaying the increase in energy costs that we saw in March, similar to the CPI.
Do you think it's because it's maybe a little early to capture some of the increase, Jose?
You would assume that. You would assume that maybe a lot of the surveys were done earlier in the month and didn't, capture the more significant increase in gasoline. Let me just show you guys a gasoline chart month over month, and then I'll show you crude oil so you can see the difference here. Yeah, so here you can see this is retail gasoline prices up 25% month over month in March. And then if we look at WTI crude oil,
Straight from 60 to 120 there, although.
And just working the monthly thing here so they can see the monthly month over month.
And if you have questions for Jose, please direct them to us on Interactive Brokers LinkedIn feed and on X.
Yeah, so here you have it, Andrew. 41.6% month over month move in crude, 25% month over month move in gasoline, but only an 8.5% increase month over month in PPI. So, expect April to potentially reflect a more buoyant increase. Although, of course, this report is welcome. From the services perspective, we saw a 1.3% month over month increase in transportation and warehousing. Other services up 0.1, trade 0.3. So, pretty cool report. It's really, the fear here was that energy was going to reflect a much bigger increase, similar to what gasoline and crude oil reflected. So I guess that'll be back in April or in May. But for now, markets are doing well. Yields, however, are back to their flat line. They're not really going down much. I mean, even though we got a decline, Andrew, 4% on PPI is still high. So even though we missed 4% is still quite high. We saw a little bit of a rejection here at the downward trend line around 69.12 and looking to open around 69.03. This has been in overnights, been above 69, below 69, now above 69. So let's see how, when the market opens, let's see how it handles that 6,900 level.
So the bottom line there is cool for now, but potentially worse to come next month report. Probably on both legs, CPI and PPI.
Yeah. Now, if you have a deal from the Trump administration and Iran, then that would embolden the bulls, because they won't pay attention to the April inflation reports, because presumably May, June, and July would be a lot better. So, that's a key consideration for the bears here. If, don't wait for those April inflation reports in May to maybe, lift yields or drop stocks, because if there's a deal from now to then, all of a sudden, no one's going to care about the April inflation reports in May. So that's a key consideration moving forward.
But is there a point in time when this goes on for so long that it potentially impacts economic activity rather than just being able to look through the noise of temporary inflation pressures?
Yes, and it has weighed on first quarter growth. The war started in March or late February, and it has. If we look at the Atlanta GDP now for Q1, we can see that the number is pretty weak compared to here at 1.3%. Fourth quarter of 2025 was around 0.6%. So, we're really already seeing some slowing economic activity as a result of interest rates that remain higher for longer. Going into this year, there was an expectation that we would have several rate cuts. Last year's final quarter's growth was hit by the longest government shutdown in history. And in the first quarter of this year, activity has been hurt towards the end of the quarter by these higher crude oil prices, as consumers have less capacity to spend in other places.
Yeah, it's probably adding $5 a day to my commute. I've got an exceptional commute, but it's over the month on top of what I'm already paying, that does stack up. So I think the consumer definitely, I can say from first-hand experience, is feeling the pain of this. Let's have a look at the forecast trader. How are the prediction market? What would you do with the prediction markets right now, in the knowledge that you've just got something that's coming a little lighter? And to your point, potentially we're going to get a bad report next month, right? If as you say, the readings for the PPI were taken earlier in the month and it doesn't fully reflect it, then we might get a worse report for the April read this time next month in May. So what I'm thinking is there's potentially an opportunity in the prediction markets more so than in the stock markets, because as you say, equity investors might just look right through this. So what do you think we're looking at for next month? What's the 50-50 here?
There's, the PPI contract has been mispriced, folks. I told folks yesterday, and even though the number came in way below expectation, this is the article from yesterday, forecast opinion, take the PPI yes at 3.8% for a triple. So this did pay out a triple, assuming that you bought at the level that this article suggested. The over on 3.8% was for 35 cents. So that 35 cents would have paid out $1. As far as looking forward to April, I'm almost certain that we're going to have another report north of 4%. So I think this 3.8 yes here is a bargain at 31 cents. In fact, all these yeses here, down from 2.8 all the way up to 3.8. The month of April is already halfway. So you're going to have some of the impact that we didn't capture in March in April. So this is how I'd play this. Just yes across the board, across the available thresholds. As far as the CPI, let's see what we're looking at for April. I'm expecting 3.7% for April. Yeah, so here the highest available threshold is 3.3% at 92%. So I would just essentially buy all these yeses here for CPI.
Right. And I think on the PPI there, I think the 3.7%, which would still be lower than the expectation for today. You're now looking for that to hang in there at least 4% and probably higher year over year. You're saying that the 3.8 underneath that is about 31 cents, but the 3.7 is at 54%. So a less risky trade would be the 3.7%. Not saying it's guaranteed to come in above there, but what we're saying is, like, if you think about prediction markets and probabilities, very good chance this is going to come in above. If it's going to come in above 3.8, it's coming in above 3.7. Or sorry, 3.6, which is registering there at 54%. So even that's a good buy potentially.
Oh yeah. No, I mean, I absolutely agree with you. I think that there's no doubt in my mind that the PPI is going to be over 3.8% in April. There's no doubt. Even if oil plunges, you're already 14 days into April. Oil is still at $96, so that should be enough to deliver at least a sustained uptick on the PPI.
Yeah. What other prediction events are taking are of interest to you at this point, Jose?
Yeah, we let's see what we have coming up in the week on the U.S. calendar. We have unemployment claims on Thursday. We have industrial production as well. And pretty light week on the economic calendar. So that's what we have. Let's go check out what claims are telling us. This has been pretty stable at around 210. Last week was around 220, but really in the low 200s. Here we're expecting a number above 210, but below 220. The yes for 210 is going for 62 cents, and the no for 220 is going for 68 cents. So that's what's going on the initial claims front. And then for industrial production, then we're going to take a look at the Fed funds curve here on the ForecastTrader.
Don't forget to submit any questions to us at the Interactive Brokers feed at both LinkedIn and X. And as Jose is going through these numbers, we can have a look at a particular market if you're interested, or we can comment further on the today's producer prices or any aspect of the global economy.
Yeah, so here on industrial production, expecting number above 1.1% with an 82% degree of certainty, and a number below at 2.1% or below with an 84% degree of certainty. The prior month came in at 1.4%. So expecting it to be right around there for industrial production. And markets had an initial jump here on the S&P up to 69.12, right on that downtrend line, Andrew. Isn't that amazing? That's right on that downtrend line that I drew. That served as resistance this morning on 9:30. It's just amazing. I'm not a chart expert, but Andrew, I'm a big fan of the work you do with the webinar team. You guys are always doing technical analysis, and it's just, to see this on a live stream while we're doing this report, just to see that rejection at that downtrend line, that's pretty significant. What would you think about that, Andrew?
I think it speaks to what you highlighted, kind of the looking at the report beforehand, where you noted that this is probably going to be a difficult report, but the market will look through it. So I think any equity trader who's buying this kind of shortfall is kind of being seasoned by, well, you know what, it may have come in a little light, but it's probably understating, and it's probably not going to get better immediately. So it's kind of a buy the rumor, sell the news here situation, I'd imagine, because unlikely to continue being positive. And again, how much follow through buying will there be if there's an announcement that says, that the US has come to an agreement with Iran?
Yeah, absolutely. Let's look at yields. Yields are similar to what you just said. I mean, yields are hanging in there.
Right. Yeah, that was another noticeable thing. Like the yields at the 10-year were coming down. I think 423 maybe it hit, or just 428. But it net back up. It kind of said there's not a lot of juice in this for us. There's nothing to juice a further reduction in yields. So I think that's kind of the danger going forward, Jose, is that like having bought the dip, equity investors are sitting pretty, but they might just hit a wall of resistance should yields not come down, because it means that the Fed's not going to be cutting rates anytime soon. And I'm not even sure that, is it in May? I don't know when the new chair at the Fed chairs his first meeting, but I'm not expecting him to go in there and just cut rates out of the blue.
Yeah, I'm not expecting that either. Neither is the market, as you can see. Like you said, we saw the 10-year make it down to 4.287, but then immediately it reacted back up towards 4.30. So this 4.30 area should be particularly interesting. Let's see in the last 5 days how it's fared. We got up to, on the month, we the highest we got to was 448. Of course, 450 would be significant resistance. But as oil prices have calmed down, we've seen inflation expectations relax a little bit. So we're right around here at around 430. But here's just to show, there's you have a lot of move to the upside, potential move to the upside on yields. Same story with the 2-year. This is when it leaped above 4%, folks, in late March. That's essentially when folks started to think about rate hike, right? Because the Fed funds rate is at 3.62. So if the 2-year is at 4%, that's essentially telling you, okay, they're going to hike soon. So we have some relaxation. This has been really the story with oil. Let's go on a 1-month chart.
It's actually very difficult to tell what the next move in crude oil prices will be, because I think at the weekend, or maybe Friday, I heard that tankers that had left prior to the outbreak of the war were just reaching their global destinations at the weekend. So that's quite some journey for a crude oil tanker. And so if you imagine we've had 4 weeks of disruption since then, ultimately there's going to be a deficit of live deliveries at ports and refineries.
And that's what a lot of folks are talking about in Europe and in, more so in Southeast Asia, in Korea and Japan, in China, in some of those other nations, they're talking about how they're facing a shortage of barrels very soon. That's not really evident in the oil futures market. So they're essentially, saying that oil should be a lot higher. But 100, folks, critical number. Round numbers matter, of course. This is huge. But as you can see, it'll go over, it'll come below, and it's really this big tug of war between oil bulls and oil bears here at $100. Typically, when you get oil above $100, it starts to pair equity market enthusiasm. However, when you go below $100, like where you are now, then things, people start to put on risk.
All right, Jose, that's a great wrap, a great roundup of today's report. Thank you very much for joining us.
Of course, my pleasure. Thanks everyone for joining us, of course, as always. And thank you, Andrew, for being our host. We're on next week on the 21st in Spanish. And then we'll be back on next month with probably jobs, CPI, and either PPI or retail sales, or maybe both if they fall on the same day. I haven't checked yet. Sometimes retail sales and PPI fall on the same day.
All right, brilliant. Thank you very much, Jose Torres, Senior Economist for Interactive Brokers. And thank you to the audience for taking the time to join us today. And we'll catch you next time. Bye for now.
And just one last thank you to Leora Jones. She's been helping us produce this in the morning. So thank you very much, Leora, for